I'll let the sound folks deal with it. And I think if it's cool, we're just going to keep going forward. You'll maybe miss some of the introduction, but that's probably okay.
There it is.
A little better? All right, great. Thank you for letting us know. So the goal of this panel, we'll start with the goal, and then we'll introduce ourselves. And then largely this panel is for you all in the audience here in the room, and for those of you online to ask whatever questions you have around raising venture capital. Our goal is to help demystify that experience at least a little bit. Unfortunately, it's still sort of a black box. Like there's not, I mean, a lot thanks to Foundry Group, there's a lot more information out there in the market around it, but it's still sort of a lot of questions like, how do I raise money? Should I raise money? What are best practices? And we'd like to share some of the strategies that we've seen work really well with you all to help make that process a little more accessible, should you want to choose to go down that path. Maybe I'll start with an introduction myself, and then I'll hand it over to Jacqueline. So I'm Natty. I'm a partner at Matchstick Ventures. We're a seed stage fund, so investing at the earliest part of the journey for entrepreneurs, primarily focused around companies that have a connection to the Rockies, so here in Colorado, and I have a partner in Minnesota, so also the north region of the US. We believe there are great entrepreneurs anywhere. We like to serve these sort of like underserved but rapidly growing markets, which you all know very well, being here in Denver. It's a great place to start a company, and so we're looking to back companies in this market. Before that, I was running the Techstars Accelerator in Boulder, and so over the last 6 years, I've actually invested in about 120 companies. So I've done a lot of this recently, and so I'd like to share some of those learnings with you all. And before that, I was a founder and took a company to an exit and raised 2 rounds of venture capital. So I think finally, 12 years into my entrepreneurial career, I have a good enough amount of stories to talk about this kind of stuff, and I hope to share some of those experiences with you all. And we're thrilled here to have Jacqueline, who can introduce herself as well.
Hello, everyone. I'm Jacqueline Hester. I'm a partner at Foundry Group. We are based in Boulder, but we invest all over the country. All tech startups. We typically invest at Series A. We have sort of a unique strategy where we are invested in other venture funds like Matchstick Ventures. So I'm an LP in Natty's fund. And so 25% of our capital goes to seed stage venture funds, and 75% goes direct into companies. And we typically enter at Series A. So we're often working with what we call our partner funds, these seed funds, looking at their portfolios, identifying opportunities where we can come in and lead the next round. I've been at Foundry for almost 6 years. Prior to that, I was an attorney. I try not to let people know that. And so I now feel like I'm not a recovering attorney. I'm fully recovered. I also worked with my husband and his family on a business that ended up being headquartered here in Denver called Fair Harbor, where we did not raise venture capital. So interesting, sort of different perspective. And we sold that company to Booking.com in 2018. So it's a great sort of Denver story. So I wear a lot of scars and have a lot of happy memories from living the founder journey through that company as well. So have that perspective. And I now, I've led a bunch of direct investments at Foundry, sit on several boards, and I'm often talking to entrepreneurs, often at Techstars, about thinking about the venture landscape and understanding the business of a VC as you decide whether or not to take capital from a venture capital firm, because it does put you on a different track. So looking forward to a bunch of stumpers today. I am low sugar at the moment because I didn't get a chance to eat before I came over here, so go easy on me.
Cool. Thank you for being here, Jacqueline. So we're going to go, to get things started, I want to get a sense of who's in the audience here. I know it's a little bit hard since we have a lot of folks on Zoom, but maybe even in Zoom, put in the chat if you can. Are you a founder? Are you a service provider? Like, what's your role in the startup ecosystem? And for those of you here in the audience, if you wouldn't mind raising your hands, I'm curious, how many of you are founding a company right now? Great, cool. It looks a little bit more than half. How many of you want to found a company and are sort of founder curious at the moment? Okay, great. How many of you are service providers or related to the ecosystem as well? Great, thanks for being here.
A really proud service provider over there.
Yeah. Great. Do we have any investors in the room? All right, a little bit. I think one of the goals of the startup ecosystem that's coming into vogue right now is getting more people to be investors in the ecosystem. There have been a lot of archaic rules that have prevented people from investing in startups, the accreditation rules, and those are slowly changing, which is a good thing. So I hope that in the future, everyone can raise their hand and say, I'm an investor in startups as well, you know, even as small as $1,000 or whatever it may be. So Is there someone that a role that I missed that's present here? Anyone wants to shout out?
Students, maybe? I know we have one student.
Students, yeah. Yeah. Student, great. Okay, cool. Thanks. This is helpful for us to know as we sort of triangulate answers here. I think we're going to steer most of this conversation towards whatever questions you have, but from the lens of what information is helpful for entrepreneurs or founders or aspiring founders. And we're going to mostly talk about venture capital here, but I also want to acknowledge there are a lot of ways to raise money or to grow a business, venture capital being a small, small sliver of all of the possible ways. We're happy to cover conversation around the other ways of funding a company or starting a company, but I think we're going to steer a little bit more towards that thin sliver, which is venture capital, which is probably outsized in its sort of perception in entrepreneurship for how much how much of the role it plays in it, but is the focus of the conversation today. So I'll kick off with the first question here to let you in the audience start to think of your questions for Jacqueline, which is, when should a startup consider raising venture capital, and maybe when should they not?
So it's a very loaded question, and I would break it up into a couple of different buckets. So there's the sort of, should you raise venture capital at all? And there's different flavors of venture capital. So I think the sub-questions are, how much would you raise and from whom? And those, the second two questions I think are important because, as I talked about before, you sort of, once you're raising venture capital, you're sort of on this track because of the expectations of the investors that you've now taken money from and the expectations that they have to their investors. It's important to remember that venture capitalists, we are middle people, and we sell money, and it's other people's money, typically. So I think it's, there's sub-questions that you need to be thinking about, but raising capital at all is a question that you should be thinking about, and that has to do with what kind of business do you want to run, and what level of risk are you comfortable with. Once you, often folks raise capital because they sort of need to get the company up and running before they have enough revenue to be profitable, but also sort of pay people to help them build whatever they need to build. And so that's typically why you're raising capital in the first place. And so immediately you are taking risk with other people's money if you raise capital. So you have to think about your comfort level with that. Often founders are putting their own risk in, whether it's with their own personal capital, sometimes their savings, which I've experienced, or just even your time or the opportunity cost of having a stable job, right? And so all of those things should factor into the decision. And it's, you often want to raise capital at a point where you sort of know what you want to build, you know what it might take to build it and what kind of people you might need to hire to sort of get to market or get a prototype out or sort of start being able to sell to customers. And thinking about whether you want to be, from a venture capital perspective, on a really pretty intense journey of I need to grow really big because venture capitalists want me to have an exit at some point and either sell my company or go public, get liquidity. Or do I want to sort of maybe raise some capital from smaller investors or go to a bank or things of that nature, crowdfunding, there's other options, or have customers fund my business, right? The best option, and sort of have a more slowly growing, more sustainable, perhaps profitable, which is sort of a word that we don't think about in venture business. And I don't like the word lifestyle business because I think it's sort of makes people feel small that want a business that isn't going to be this like big venture scale thing. A lifestyle business is basically like, do I want to have a sustainable business where I can pay myself and some other people and have a nice business to pay the bills and perhaps grow it over time and create that asset. So I think there's lots of different ways to do it. The important thing if you're going to raise capital is to really understand who you're getting into business with, what they expect from you, and sort of the track that you're on.
That's great. Let's open up for Q&A. What questions do we have in the audience here? We'll start with a question in the audience, and then for those of you on Zoom, please put a question in the chat, and that will get relayed to us as well. So what questions do we have from the audience here about raising venture capital or about VCs or about what we do between 9 and 9? Here, let me bring, I think we're gonna, do we have a mic that we can get over here? Great.
Hi, Jackie. I'm Jackie as well. Oh, you're Jacqueline. So question. So you invest in Series A. At what stage should a company come to you and talk with you before even starting to raise a round?
So, yeah, so for us, It's hard to say because all of the names have changed over time. So like, what is a Series A, right? And so typically we're looking for companies that already are sort of up and running. You've got a product, you probably have some customers, you have either maybe signs of what they call product market fit, which means that you're selling a product to the market and the market actually wants the thing that you're selling. Often revenue is a thing that we're looking for. In today's market, things are sort of crazy and things are getting funded at really high valuations where they have none of those things. So who am I to say? Often if it's a seed round, if it's sort of the first round of capital that you're raising or a smaller round, we will maybe we will say, hey, this is too early for us. Check out some of our partner funds. So the Matchsticks of the world and the 40 or so partner funds that we're invested with. You want to make sure that while it's great to sort of be long-term thinking and spend time with folks that might fund your company in the future, you really want to focus on firms that are a fit for you. So if you're going to go out and raise a seed round or your first sort of friends and family round or whatever you want to call it, you want to talk to firms that actually want to invest that early, that have that risk profile, that are comfortable writing a check that will fit sort of in the size of the round. So if you want to raise, $1 to $2 million and you're talking to a gigantic fund that likes to write $30 million checks and, see a spreadsheet of all the data you have on your, annual revenue, it's probably not a fit. So you don't want to waste too much time with folks that aren't really a fit for you. And so it's really important to understand the business of that firm that you're looking at and what types of rounds they like to do and be talking to people at the right stage.
I want to build on that with one comment, which is one thing that Jacqueline said early on was sort of like Series A, what does that mean now? And this is sort of an evolving thing that's come up in the last probably like 5 years in venture capital is we used to have like the first round you used to raise was a Series A. Then seed rounds came about because Series A rounds kept getting bigger and bigger and a little bit more later stage. And now those seed rounds have gotten a little bit later. So now you have pre-seed rounds. So the nomenclature in the industry is actually like a relatively big barrier for people to get involved in it because it's like, how do you even know these terms and that they're sort of changing? And so that's where I think it's helpful to have people demystifying it because I don't know how many people in here knew that there are pre-seed rounds and now there's like earlier rounds than that. So I think building on what Jacqueline said, it depends. Like for a Jacqueline, you want to go when you have like real revenue, you have a real working business. For me, as a seed stage, and we do pre-seed as well, I'm okay investing at idea up to about $1 million in revenue. Like that's our investment profile. And so getting to know like what stage are you as a company and making sure you're talking to the right investors at the right time, like Jacqueline said, is important. And yeah, and so those terms are sort of changing as well. And I think funds are getting better at putting on their websites like, this is when we invest, this is how much we invest, so that you can do that. So do your research ahead of time and go look at their firms and their websites to make sure it's a good fit for you. And the firms should filter as well. Like they'll get a sense of how far along are you, and they'll say, oh, you're a good fit or not for us.
So today, a Series A round, just to give examples of round sizes, I'm seeing anything from 4 million to, I'm not joking, like 100 million. Don't do that. But so sort of 4 to 15 seems to be the sweet spot for Series A rounds today.
And that's how much you're raising.
That's how much you're raising. That's not valuation. And so you're selling anywhere from maybe, it's all over the place, but 15 to 30% of your company and around like that. Natty, what's a typical seed round? Maybe here, for the local crew here in the Rockies, like what's the round size that you're typically looking at?
For seed rounds in Colorado, we're looking at about $1 to $3 million in capital raised. And pre-seed rounds are anywhere from $500K to $1.5 million. I know those overlap, but one of the things that I think is helpful also is that this is more business advice than a VC advice, which is you want your traction for your business should be around ahead of what you're raising. So by that, what I mean is like, wait and raise your first round of capital as long as you possibly can, because that gives you all the leverage. Like if you have a working business and you have an exciting team that's together, people are going to be more likely to give you money than if you're at the earliest stages. I recognize you can't always start a business without capital or at the earliest stages, but the longer you wait for each round, the better and more leverage you're going to have in those conversations with VCs. So for instance, maybe you don't have Series A level traction when you want to raise a seed round, but if you have, wow, we have about 250K of annual revenue, our product's really working, and you go and raise a seed round, that's much more likely to have better terms, better investors than if you're earlier. So I I know that not every business can control their trajectory that much, but just know that the more ahead of the round you're raising at you can be, the better for you as founders.
I think one thing to add to the question earlier of like, should I raise, is sort of when you're at a point where you're like, if I had capital, I would know exactly what to do with it. And I feel like I'd be pouring gas on the fire that I've started. And that's the point at which it's like, okay, let's take some risks. Let's bring in some capital. We know what we would do with it. We sort of see line of sight to how to go after customers, and we've done all that work. That's really when you want to start thinking about selling it, because I think the hardest thing is if you sell too much of your business before you know what you have, then you just have to think about like, what do you have left that you own, and all the hard work that you have left in front of you to do, and making sure that it's going to be worth it for you.
Let's do a question online if there are any. Do we have any online questions?
Testing. Okay. Katie Goldman, how do you find or screen these firms Jacqueline mentioned to see if they are a good fit?
It's the hardest question in the industry right now. There are at least 1,000 early stage funds out there, and I bet that number is like closer to 2,000 today. So like everybody wants to be a VC. There's tons of seed funds. There's a lot of capital sloshing around, and there's the other crazy thing about early stage venture capital right now is you've got pre-seed funds and seed funds investing in the same type of stuff that gigantic multi-billion-dollar platforms are investing in. So all of a sudden, like, hedge funds are paying attention to early stage venture. I lost a deal this morning on a ridiculous price to a hedge fund that all of a sudden decided they want to invest in early stage companies. And so it's really hard to navigate. That's the hardest thing. And so get out there, start building your network, talking to founders. The best way into a VC firm is an intro from a founder. There's lots of firms out there that will also take, cold inbound pitches. But it is way easier if you can find somebody that can send you an introduction. And then honestly, there's Crunchbase, there's PitchBook, there's resources out there. There's something called NFX that was trying to do like a matching tool. There's networks like Techstars that you can get plugged into by going through an accelerator program to get access to those types of things. And so you really have to do the research. A lot of funds will put on their website what they do. You can look for funding announcements in Techstars and Forbes and Fortune and start to see what kind of firms are doing, are funding businesses that are around your stage. But it is a really big challenge of the industry and a really big challenge to democratization of access to capital is how do I even go about navigating this in the first place? And so building startup communities like we have here in Denver and Boulder and the Front Range are really important because founders can help each other to navigate those hard things. And you should just go to Matchstick because they're the best.
Thanks. One other resource that Jacqueline didn't mention that I would point people to is Angel List. And one cool hack that you can do on there is you can look up companies and see who invested in similar companies. And then you can reach out to those investors because maybe someone did really well investing in a company that had the same business model, but at a different market. And so they're more likely to be, that worked really well for us. I know what you're doing. I have firsthand experience, and that's more likely to be a better partner for you. And so you can start to look through those like Angel List and figure out like who invested in that company. Maybe I should reach out to those investors. One trend is I think investors historically have tried to not be very found because the networks that they invested in were sort of these closed networks coming out of like traditional top tier Ivy League schools. And that's where all the innovation was happening. Luckily, that's changing all over the map, but it's still taking a while for the organization of the venture landscape to be searchable, findable for entrepreneurs. But it is getting better. But to Jacqueline's point, it's really hard and you just kind of got to start networking. Anyone can email me. My email's on matchstickventures.com. I have a list of all of the seed funds in Colorado that I can send to people that we've gotten organized. So I'm happy to send that out. I think everyone in Colorado is excited to be found. We want to meet with you all. So I think it's better here in Colorado, but it is still a hard question.
Yeah, and I would add that Twitter is an amazing thing. I've seen companies and funds get funded on Twitter. So like just getting out there and like starting to follow people and founders and seeing who they're talking to, and like it's pretty incredible, I think, what social media has done to open this up to folks anywhere. And I think the other awesome thing that's a relatively new trend is and that was really accelerated by COVID, is the idea that entrepreneurship can happen anywhere, that great companies can be formed anywhere, and that you don't necessarily have to meet people in person to get an investment done. And so this, I like being able to invest via Zoom, which we've now done a few times, and founders being able to raise via Zoom has really accelerated things almost to an uncomfortable point. And it's sort of exhausting. But it's also a pretty incredible thing at how much sort of capital has been opened across the country in places that it wasn't before.
I thought I saw a question here. Yeah, we'll do one in the room here. Got the mic on delivery.
Okay,
We can hear you.
you can, okay, this is about democratization. Let me give you a couple of statistics. 25% of the population during COVID from 1.5 to 1% of all VC. We're talking about my Hispanic people. Why? No questions asked. What? My people have heard this talk for a long time. We start the most small businesses, we get the less money. What's being done? What can be done? How are you guys taking the lead?
Yeah, I mean, I sympathize. I can't empathize because I'm not Latino in that. And I'm sorry that that's how the industry has been. And, you know,
And it's sad. You mentioned how we're up to 2,000 funds. The Latino Leadership Institute, it's an organization started by Federico Pena and Tim Marquez. They're up to a national level. They are going blockbusters. Yesterday on Facebook, when it was still up, they posted a graphic. Hispanics only get 1% of all VC. 3 years ago, it was 1.5%. Every other group is getting the funds except for us. And we're the ones, the economic driver. I mean, it just,
Yeah.
I'm sorry, my old school Chicano activist is just ready to
I
blow things up.
appreciate it. I mean, if we're not having these conversations, we're not going to change anything. So I think it's a great question to ask. And I don't have a good solution for it. I mean, I think there are positive trends and and it also hasn't been fixed. So I want to acknowledge that it hasn't been fixed. I mean, I think the positive trends are a lot of the democratization of access that we've talked about, but it still hasn't shown up in the numbers. So
Yeah.
yeah, so it went down during COVID.
Yeah, it's the same thing happened with women.
Yep.
And so it remains a real challenge. And I think that one thing that happened during COVID is that folks just went to their existing networks, right? Because it's where the trust is. And so that's a challenge. However, so a lot of the 2,000 funds I mentioned, there are a lot of funds right now, and there's both, so fund to fund, so institutional capital being focused on this, as well as the funds themselves focused on backing underrepresented founders, including a lot of focus on Latinx founders. There are like large banks, there are large institutions that are now focused on who they're like. Can I finish that? Okay.
We've been hearing it for decades. We've heard it for decades.
Yeah, no, I understand. I'm just telling you what I know. So like there are one of the biggest challenges. And so the reason I think that there's a challenge around lip service of like, oh yeah, we're focusing on it, is who the decision makers are. They're actually writing the checks. And so the biggest problem has been, you could talk all day long about, yeah, we're going to look at companies founded by different people. And folks tend to fund companies that look like themselves. And so while the industry was for so long driven and still is by white men, that's been the biggest challenge. So we are behind. I will absolutely say that. But I think that you will see change happening where the face of the check writer is changing, because folks are starting to realize that the demographics are shifting, and who speaks for the dollars and who is driving economic change are not the typical funded founder of yesteryear. And it's not even about what the founders look like. It's who the customers are. So who's driving those dollars, and who the customers are, not only as an individual consumers, but also businesses, and who business leaders are that are making these decisions for B2B companies. So I totally hear you. I think that we're way behind, but I think that as we continue to change the face of the investor, that will start to help. And there are also funds that are focused on this. At Foundry, sort of our model is to work with our partner funds and look at companies coming out of their portfolios, right? And so we want to make sure that we are being inclusive, that we're extending our network. And admittedly, for the first couple of years that we were doing this strategy, we looked at the portfolio and we're like, okay, this looks like us. These are people we already knew. What are we going to do about it? So we went out last year, we raised additional capital from one of our investors, and we've now invested in 10, going on 12 funds where the GPs themselves, so the people that are actually writing the checks, are diverse. They don't necessarily have a diversity mandate on what they invest in, but I tend to think that as you see the shifting happen, it organically happens. And I almost think it's better for those founders if it wasn't a diversity mandate. It's just like, this is what a great founder looks like. And so, you know, from a Latino perspective, an example of a fund that we're invested in is Chingona Ventures. Samara is based in Chicago. And it's every single story she has, like, even if it's not necessarily a Latino founder, it came through her Latinx network. And it's something that she has that nobody else has, and that we want to make sure we're adding to our network. And so I think it's slow. I feel you. It's way behind where it should be. But there is more and more attention being paid to it. And I think we're starting to get past this piece and actually putting like wire or hire, right? Fund these companies or hire folks that will know how to fund these companies. And I hope that a year from now, if we're having another one of these conversations, things have actually changed.
And
I appreciate the question.
keep bringing the conversation up. Like, if we're not talking about it, change isn't happening. So I appreciate you bringing it up.
I appreciate it. So a little bit of my roots, if you're familiar with the radical movement at CU in the early 70s, not close to it. My first cousin, once removed, was at the heart of it. And then after 10 years of being in this community, I'm just done. I don't care who I annoy. The voice is going to be there for my people.
I appreciate it. Yeah. We'll do another question in the audience here, and then we'll go to one online.
Hi there, I'm Andrew.
Go ahead.
I'm an early employee at a Series A stage company. We're considering going out for our next fundraise, and I'd really like to hear from you. You know, from a diligence perspective, particularly a business diligence perspective, what should we do? Kind of getting our ducks in a row ahead of time, outside of the pitch deck. What are you going to look for when you do business diligence? Is there a lot of business diligence being done before the term sheet's being written at this point? And what's happening after, post term sheet?
Let's also, the question, in case people didn't hear it, is sort of like, what diligence do investors do? You shared your story, which is you're a Series A company going to Series B. If it's okay, I think we'll extrapolate and just talk about like diligence that investors do in general, just so it applies to more companies in here, because there aren't that many startups going from A to B. So is that okay with you? Okay. So in terms of diligence, it's all across the board. I mean, there's been sometimes investors do very little diligence. Sometimes investors dig like way too deep. I think you as the entrepreneur, what you can do to control that is just get ahead of it and get a little bit prepared. Create a Google Drive folder, put all of your incorporation documents in there. If you have employees, put their employment agreements, their inventions agreements, like just look to be organized so that you can make it easy on the investor to sort of like go through all that stuff, your cap table, kind of like any of that stuff you have. If you have customer references, if you have a financial model, that kind of stuff makes it easy for investors. And what can be nice, if you have that prepared ahead of time, instead of the investors sending you a list of things that they want to see, and then you have to go frantically put stuff together, you can say, hey, here's our data room, go check it out, and let us know if you have any questions. And it sort of puts you in the offensive versus waiting to see what they ask for from you. And so I would just organize that stuff as much as you can. For certainly like a seed stage company, you may not have much of that stuff because you're just, a few folks getting started, and that's okay. But whatever you can get organized, do get organized. Investors today are typically asking for like a pitch deck. That's probably about 10 to 12 slides that introduce the business. We're seeing a lot more one-page summaries, which is great too. And whatever can get it across. If you can record a video, we're starting to see more video pitches going around. It's like, hey, here's a 3-minute pitch. You get a lot more from someone when they can explain it versus having someone interpret what's happening in the deck. And then I would say, like, if at all costs, like, steer to a meeting as much as you can, because investments don't happen in data rooms. They don't happen in financial models. They happen through a conversation and a relationship. And so you want to use those tools to steer you towards a meeting as much as you can.
So for Series A, so sort of later stage, having a data room is great. So that's a good signal to an investor that you've got your shit together, and having it ready so that maybe you've done a meeting or two and they say, do you have a data room? And you're ready to go. Right. And so that's an indication that they want to dig in. You don't need to have, I wouldn't send a data room out at the beginning. You start with a deck and then you sort of have a meeting and see how they feel and then let them start to dig around. You want to have, for a Series A, you definitely want to have not just the pitch deck, but then other materials put together on different aspects of the business. So some really good ones I've seen will have a separate product roadmap. They'll have a separate sort of set of case studies on different customers. They'll have a separate set of, a deck around the team. Having a sort of a pretty baked financial model, a pro forma model, which we all know that the only thing that's true about models is that they will be incorrect. But sort of the idea of this is what our business looks like today. This is the growth that we predict if we raise this capital. Here's where we think we will be by the time we need to raise additional capital, because that's what investors are thinking about. Like, how far does this get you and what does the business look like if like when you run out of money and have to go raise more? And then, for depending on the type of business, having cohort data on customer sets that have been around for a little while. So you can sort of show this is how this customer has grown over time. This is what our churn looks like number of customers leaving us or revenue that is leaving us on a monthly basis. So you want to have all of that stuff really baked so that you can sort of show and not tell and just say look how things look. And you can go through it with investors. Another thing folks will want to see is what your plan is on hiring. And so having, if you're raising, especially if you're raising a good amount of capital, you're raising $10 million, you better know what your hiring plan looks like and what you're spending that money on. I think those are most of the things I've seen in good data rooms. And then having a great customer reference list, which you don't necessarily want to share right away, but having your go-tos that have agreed that they'll do calls for you, even having some recordings of, I've seen that, demo recordings that can sort of show, like if this is a B2B company, show investors what it looks like for customers to sort of interact with your product and what that sales cycle looks like. So getting a lot of the data together as much as you can. I think Natty's got a good point. I've seen recently decks that come as a video, so you can click through them on your own, but they'll come with a voiceover that the founder records, and it's really helpful to sort of get some color on it that you can't really put in the deck.
You had a question over here?
Hi.
I think you're good.
Okay. I'm Lauren. I'm founder of a startup started this year, but so I kind of have a two-part question, and maybe you answered this a little bit, Jacqueline, but so first off, when you're applying for that, that first VC company, you're submitting the application. And as far as like the pitch deck, what kind of sets you apart? Like you said, we can be organized, but what really is the trigger of, oh, I want to meet with this company? And then second, when you get to that meeting, additionally, what sets you apart as a founder to really make you guys want to invest in the company?
So by the way, I forgot cap table. Make sure your cap table is clean and ready to go. Sorry. So fundraising is storytelling is the thing I would say. And so whether it's visual materials, whether it's the pitch, it's all about storytelling and telling a story that is compelling about why the thing you're building should exist, why the market is exciting, especially if you're talking to VCs and bigger firms. They need to see like a giant market opportunity, even if you're starting small, but they need to sort of see that. I think decks that like are really, I hate saying it, but like the design looks good and there aren't lots of typos and you've like bothered to have somebody look at it, like just being clean. There's tons of companies, investors are just looking for reasons to say no quickly. It's sort of how they have to operate. And so I think having like a nice looking deck that's not too long, that easily tells the story of like, what's the problem you're solving? Why is it a big problem? Why is it a big opportunity? And how is the way that you are solving it different and interesting and defensible? In the actual meeting itself, and being really clear in the deck, like clear and crisp in the deck, and then also showing like what the performance has been, what the opportunity set looks like, and like, sort of why we're going to win and who the team is, because at earliest stages, it's really you're betting on the team. In the actual meeting itself, great storytelling, knowing your stuff, but being open to feedback, I think is really important. So I think there's some investors get turned off where there's like a quick answer to everything and people get really defensive because it's hard to build a business. And so you've got to be open to, things not going exactly how you think they're going to go. And so I think that sometimes investors are looking for that. And they're really looking for human connection. So not everyone's going to be a fit. Like you've got to have chemistry. And so it's okay that like a bunch of funds are going to say no to you. It sucks. but it's really part of the process, and you really want to find someone that's going to be your partner and that you fit with well. So it's worth doing lots of meetings to find that person. The other thing, last thing I will say is if you're pitching with co-founders, practice and know what thing each person is going to be the expert in. Cutting each other off or disagreeing or making a face when someone else is responding to something is just like a surefire way to have someone be terrified that your founder dynamic is off and they're not going to want to back that business.
Yeah, and in today's market, there's a lot of startups, and so it's a little bit of an extra challenge today to stand out. And so those little things are sort of easy ways to be like, I think there's a co-founder dynamic there that I don't want to, get involved in. So it's easy to say no. So I agree with that. The only thing I would add to what Jacqueline said is I think what she said is awesome all around and a little bit more Series A specific. Like if you want to go like pre-seed and seed, well, I think what you're trying to answer there are kind of like 3 key questions. First is why you? Like what's your, like, why are you going to create a multi-billion-dollar company? And that doesn't mean like, oh, I went to Stanford and I did this thing. It's like, we all have interesting stories and backgrounds. Like why should this investor believe you're going to overcome the challenges of starting a company, able to build a big team, you have that grit, determination, resiliency around starting a company. So first question is like, why you? And I mean that for the whole team. The second I would answer is why now? This is one that most startups miss, which is like, what's the fundamental change that's happening in society that means that this is the right time to start this company? A lot of, like, there's this sort of saying in venture is like, gosh, I'm going to blow it now. It's like, if you're like early, you're wrong or something. Like there's a lot of businesses that have been started that are like great ideas, but just they got the timing wrong. So you really want to tell a story around like, why is this the time to do it? Is there some technological innovation that's happening right now that this is the perfect time? Like, let's go back to like Uber, for instance. What was good about their timing was everyone had a smartphone in their pocket and there was ubiquitous GPS in people's pocket. Like the timing for that was like perfect. There's a lot of stories. So like first question, why you? Second question, why now? And then the third one I would say is why this? Like what is the unique insight that you have that you're bringing to market? And why is that not necessarily better than what's out there, but different than what's out there? For something to be better, it kind of needs to be 10 to 100x better for investors to get excited about it, because people don't switch products unless they're 10 to 100 times better, which usually means that there's some different point of view or different thing that you're bringing to market. So for me, those are kind of like the 3 questions, especially at seed, to ask, because you probably don't have a bunch of the data that shows, hey, this is already working. Like if you have, customers, revenue, that stuff is more important than that stuff, or maybe as important, but you may not be at that point yet.
So I think it's not the quote you were looking for, but I think there's a thing that Bill Gurley from Benchmark would say, which is like seeing the world exactly as it is today, right? As opposed to trying to be early and predict the thing that's going to happen in 10 years, because things always take way longer than I think folks expect. And so there's been a lot of companies where they had this like great technology, but it was just too early. 2 other things that popped into my mind to add are the difference between passion and obsession. So a lot of people are passionate about things, and startups are so hard that passion might not cut it. You sort of have to be like really obsessed, where like I have been put on this earth to do this thing. I can't do anything else, because it will, like every company that we've invested in that's been successful has probably almost died at some point. Like there are major ups and downs, and it's really hard and it's exhausting for founders. And so you've got to be so obsessed with it that you can't do anything else. And that can be dangerous if you can't get to a point where it's like, this thing isn't working, and recognizing that. But I think that's a thing that that investors are looking for. And so showing not only that founder market fit, where it's like, I've lived this pain point and I couldn't take it anymore, so I had to leave the thing I was doing to go build this. That's the type of thing that they want to hear. And then a second thing, Natty, as you were talking, that popped into my head is on competition. A bad answer to what does the competitive landscape look like is no one else is doing this, because there may not be anybody doing it the exact same way that you're doing it. But it is rare that an idea is truly novel. It's really about execution. And so what they want to know is that the competition, why you're better or why you're going to be better, and that you're going to out execute anybody else that's trying to do this.
Let's, I see a few questions here. Can we do one online? We'll do a quick one online and then we'll go in person right here.
Okay, this is Pete Cruz. how risky is it, if at all, to be a solo founder looking to raise money for the first time? Is it problematic to lack a co-founder?
Gosh, there's a lot of viewpoints on this. Some investors care, some don't, is sort of the short way of thinking about it. If you are a solo founder, you just need to have a good story around who are you going to bring on, know the gaps in your skill set, hopefully have some people identified who you might bring on, and just have a really good plan around it. Some of the most successful companies out there, Oracle, Facebook, et cetera, even though Facebook's down, have been founded by solo founders. And so there are a lot of really successful
What
solo
about the
founders.
Winklevii?
Yeah, right. But I think investors are the reason why investors are a little wary of solo founders is there's just a lot to do in a startup. And it's like, who is going to be there with you when it's really hard? Who is going to be there for you when nothing is going right and you need to pick each other up? It's not saying you can't do it on your own, but it's much harder. Investors have seen. And so there's a little pattern matching around preferring teams over solo founders, but it's not a rule. Just know that you should have a good story around how you're going to augment yourself, because you are going to need to.
I think there's like a big trend around the sort of solopreneur today. And so I think there's plenty of funds that are open to it and excited about it. I would say it's far better to underwrite a solo entrepreneur than it is a bad team dynamic. So to force a co-founding team,
Don't go find a co-founder.
is not a great thing. And so I think as a solo, I mean, it's probably super early if you don't have anybody else with you. So you got to think about the team that you're going to build around you, or folks that you already have in your corner today. And then I think what investors will be looking for is like, is this a dynamic individual that's going to really attract talent and sort of know how to sell to not only investors or customers, but to sell to potential employees that are going to want to come work with you. And that's I think the biggest thing that they'll be trying to underwrite if they go with the solo entrepreneur. And it's just lonely. So you got to have people around, even if they're not technically your co-founders.
Yeah. And one build on that is like, sometimes people feel like, oh, to attract people, I need to be the most charismatic person. Don't take being able to attract people to work on your project to relate to being charismatic. That does not matter. I mean, some of the best people I know who are able to attract people to work for them are the least charismatic people. They just have this insane vision. They know their community super well, and people want to work with them. So I think Jacqueline's totally right, but I just wanted to put that like finer point on it.
Yeah, and it's like not just extroverts. There's
Right.
So, anyway.
All right, we had a question right over here. Yeah.
Hey,
Hi.
hey, my name is OJ Johnson.
I can't see you, but I'm gonna do this. There we go.
Hey, guys.
Hey.
My name
Thanks.
is OJ, and I'm the founder of Wellview. We are a concierge wellness collective. Actually, a question about this. I wrote this down. For business with marketable value and revenue, which got interrupted by COVID and emerged with a tech front afterwards, where's the best place to start, since we already have a base of users and clients and respectable companies across the work with us?
Let me make sure I understood the question. So you had a business that was sort of non-technical pre-COVID. COVID accelerated it into a tech business. There are users and customers. And your question is like, where do you go to find investment to take it to the next level?
Well, in a sense, we started in 2018, and 2019 it got profitable, which was surprising. And 2020, thank you. 2020, I've never had investors. This is all self-funded. When 2020 happened, COVID shut every partnership and relationship down. So moving forward, 2021, we emerged through 2020, worked out a product with a prototype to add a B2C concept to what we already do to increase profitability. Long story short, we're recently stuck in a point where I think to finish what I need to do, I need to start speaking with people. And since I never raised a seed fund of friends or family, I kind of have been stuck. Like, where do we go from here? And how do we just push on to finish what we're working on?
Interesting. So if I'm sort of extrapolating out of that, there's sort of a question of like, how do I find the support to go to the next level? How do I make sure maybe finding some advisors or finding capital to make sure you get that product out the door?
Exactly. We need all of that help.
Yeah. Well, the one thing that's good is you're in an amazing community here in Colorado. Like, this is the most supportive, helpful, give first community that I've seen. And I've traveled around quite a bit. I mean, I'm obviously very, 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 very biased around this community, but like, I think the main thing here is like putting yourself out there and asking for help, kind of like you are right now. figure out like there's a lot of mentors around who can help on the advising side of things, find fellow entrepreneurs. Like I think if you just sort of raise your hand and say, hey, I need help in these areas, like I bet you someone here, like, is there someone here who'd be willing to connect with him afterwards and maybe share some like advice or fellow entrepreneurial like spirit and whatever? Any hands? Got one over here, one
6
behind you. So like, I think there's a lot of people around, which is good. And then on the flip side around, maybe on the mentorship advice side of things, I think there are resources here. There's also a lot of accelerators, which you can look into. Techstars up in Boulder. There's 3 Techstars programs in Denver, just to name a few. What? Rocky's Venture Club. Yeah, there's a lot of amazing resources here. I think if you actually go to coloradostartups.org, I think it's .org, maybe .com, they're aggregating a lot of the resources in the community, which I think could be really good. And so I think there's a lot of resources. You just got to start looking and don't be afraid to raise your hand. And this community is very supportive and will be helpful.
I would just add on the product development side, if that's the thing you're sort of stuck at, I think that it's important to sort of define, like, what do we need this to look like to just get going and to get it out to market. And I think that there's like the sort of, forgive me, but like the fuck it, ship it attitude that a lot of Silicon Valley startups have, where it's like the product's not perfect, but you just got to get it out there. I think in later stages that can be dangerous, but when you're early on, sometimes you just got to get going. And so I think like taking a step back from it and looking at it with your team and being like, what exactly do we need to do to get to a point where we feel comfortable that this would be out there, knowing that we will continue to iterate on it and not waiting till it's perfect.
So right now we actually are in the process of we do have a prototype that's fully functional. And like I say, the services provides services that most people that live in Denver probably utilize in their apartments every day. And we've got an app that makes it easier. And basically the MVP's been built, but you run out of funds when you've been doing this, especially since you haven't been working through 2020. So basically, I'm tired of selling Bitcoins to keep up with the company. I basically sold almost my entire portfolio to keep the company running through 2020 and keep my employees alive. So it was a bit harder. And now I'm actually trying to figure out, how do I surpass that? We've got a prototype that functions and we are putting it in front of people constantly. And a lot of residents and, PMs and assistant managers in this properties we work with, they love the service. But what we're stuck in right now is production. And I feel like that's why I'm here.
Yeah.
Well, and this might be like relating it back to VC is this might be a good time to consider raising money, in the sense of like what I'm hearing a little bit here is kind of this common J curve, which people talk about, which is sometimes in businesses you need to invest for a while before you can see if it's something that people want. And traditionally VCs like investing in J curve style businesses because, but it all depends on the slope of that J curve once you've made that investment. So what I would encourage you to do in this is there's a strategy element, which is like, okay, what's the best way to get you to a point where you get that slope and you get to start getting users going? And do you need capital to do that? If you need capital, then you need to start working on the story around that and figure out who are the right investors for that. And I would at the same time figure out what's the path without raising money, because there's no guarantee. We're talking about raising money here, but it's still very hard to raise money, and you don't want to. Ideally, you don't want that to be your only option. So if it's okay, can I move? I want to make sure I move on to other folks since we're almost running out of time. I'm happy to connect afterwards too, if you'd like. Okay. Question here. Yeah.
Yes. Hi, Jacqueline. Hey, Natty. I'm Susie. I'm a Denver-based founder. And Natty, congrats on the recent Fund 3 that you recently raised.
Thank you.
I'm curious, looking at conversations that you're having with founders, what are some of the key milestones or metrics that you're tracking towards as you start investing out of Fund 3?
Cool. I'm gonna instead of answering it from my perspective, I'll share sort of like how I think investors think about metrics and milestones. And this is, again, the context is important. So if you're Series A, those metrics or milestones may be different than for a seed fund like us. So for us, we're happy to invest, like most seed funds or pre-seed funds, at the idea stage, where there's a team that has sort of answers those questions that we talked about earlier. Why you, why now, why this? If there's like a really good story around it, and we feel like, yeah, this is the team to capitalize on this opportunity, like we'll invest that early. But if you think of a spectrum, on one side is faith, on the other side is evidence. Like when you're pre-seed, it's all faith on the team. Like, is this the right team to pull off this opportunity? Do we believe that the societal changes that are going to unlock this market are happening right now? And is this the right approach to it? Like that's faith. And a lot of seed funds will do that. Then you start to move a little bit more towards evidence. So you've built a product. Now you have, you can prove, hey, not only are we the team who has a great idea, we can actually build. So that's sort of like moving towards more evidence. Then you start to say, oh, now we've launched the product and we have maybe users, hopefully revenue, customers, like, ooh, great, more evidence. And so your job as a startup is sort of to move towards evidence from faith, regardless if you're raising money or not. And I think the more you move along that path, the easier it is to raise money if that evidence is good. The paradox of that is, though, the more evidence you have, the more you can be judged on. So if that evidence isn't great, you actually may have been better off raising when it was just a faith story than an evidence story. So it's a weird paradox, and there's no way to solve that, but it just sort of is what it is. I saw you flinch. So I was like, oh my God, what's happening? So anyways, long story short here, I think at the seed phase, like you're just trying to tell a great story first and foremost about the team and like, why should people believe in you? Second is, if you have evidence, like what is the story around that evidence? Is your retention really good? Most seed funds are more focused on retention than growth. And they want to know, like, did you prove out the value hypothesis? So one way to think about it, in a company, there are two hypotheses. One is the value hypothesis. Did you build something that people want and that they use that solves a problem for them? That usually shows up in your retention, your usage metrics, if people are paying for you. And then the second hypothesis is the growth hypothesis, which is, okay, we built something that people want. How big can it get? How do we acquire users? Do we have a low cost of acquisition? Is our long lifetime value of the customer high? I would say from like a seed lens, all I care about is that value hypothesis, in addition to like that faith, are you the team to pull it off? So if you're telling a story to VCs, those are the things you want to nail, which is like, why should you believe in us? And then do we have some evidence that this is something people want? And so sometimes you see startups do something where they're like, okay, we just built a huge wait list of potential users. We have 500 potential users. That's not that interesting to, in my view, a sophisticated seed fund. I would much rather you say, I have 10 users who can't stop using this every single day than 500 people on a wait list. Like if we have a product that we have 10, 15, 100 people using every day, or whatever the right usage pattern is for that type of company, way, way, way more interesting than, hey, we have 500 people on a wait list. So hopefully I was giving some examples there of like how seed funds think about those metrics early on.
Cue the music.
So, and then from us, from a match, like everything I just said applies for how we think about stuff at Matchstick. So it's like people first, then what are you working on and why are you doing it? So happy to talk with you more too.
I think as you get to later stages, growth is going to be huge. And that's really what investors are looking for, is just like significant growth. I'm talking like at the early, and you have to think about what the growth number is on, right? So, growing 100% year over year from $100 isn't all that interesting, right? But like earliest stages, I think the companies that are getting funded well are showing like 100 and 200 and 300 and 400% year over year growth, because that's showing that there is like a lot of opportunity here and that there's momentum, and that there's like a real desire for this product. And that's really what's showing your product market fit.
And I think like when you think like from a Series A lens, like I think you're much more looking like for you to even consider a business, the value hypothesis has to be proved out. And it's more of a question of like, what is the growth hypothesis and how is that proving out? And when you're seeing a business that's at $1 million in revenue growing 300% year over year, that's like, okay, there's obviously value hypothesis proved out, and wow, the growth here, the growth hypothesis could be really good.
Yeah. There used to be sort of like wasn't a hard and fast rule, but like get to $1 million in ARR and then you can go raise your Series A. And today it's just like completely all over the place. And you're seeing pre-revenue companies raise Series A's that are gigantic, which is something I invested in recently that was just announced. So it's just hard to like have hard and fast rules, and you sort of have to just like believe in your business, understand your growth story, like Natty talked about, and really sell on your ability to execute.
I think we're out of time here. First, thank you all for being here and spending your precious time with us. We really appreciate you, especially those of you also at home and our live viewing audience, or whatever they say on TV shows.
Wherever you are.
Thank you all. I can hang around for a little bit. I don't know if Jacqueline can. I'll hang around for about 10 minutes if anyone wants to follow up. I'm Natty at matchstickventures.com. You can reach out with any follow-up questions. Happy to engage there. Jacqueline is...
I'm Jay Freester on Twitter.
Jacqueline prefers Twitter. You can reach me on email.
I just have 250 unopened emails in my inbox. So
don't email
that's
Jacqueline,
more my
email me.
Yeah.
Thank you all for being here. Hopefully this was helpful. We'll do it again. And thank you for being here.
Thanks, everyone.